You know, Jason Snipe, it feels like we began the week talking about this new call from Mike Wilson, or, you know, an addendum to a call that he already had, calling for fire and ice, a greater than 10% correction. And here we are today with that list that I made. That looks pretty good. Tom Lee says today the case is strengthening for a year-end rally. Mike Santoli, our chief markets commentator, says his mystery broker has gotten more bullish. Here's what Mike tweeted. Look at this. The mystery broker backs off his call for a fuller correction, now expects stocks to work higher, cites the market's resilience, absorbing threats like Delta, the debt ceiling, inflation, energy, the EPS forecast dip, near textbook technical bottoming process, and coming seasonal strength. Is this the week that did it? Are we back thinking that the market can move higher?
Yeah, Scott, it's a great question, and I have to go back to what John just said. When I'm looking at, obviously the CPI and PPI numbers are a little bit more tame off a higher base. Of course, inflation is here. Unemployment numbers were tough from September, but claims data this week had a 2 handle on it, which is the first time we've seen that since March of 2020. Part of me, when I look at earnings and financials, which obviously have been blowout numbers, I mean, I'm really curious to see how the companies that, as John just described, that deliver things, and how they deal with supply shortages, supply chain issues, and input costs is rising. So that's where I'm starting to turn to as we head forward get deeper into the earnings season. But I've been happy what I've seen thus far.
Yeah, I mean, you see what's happening over the last couple of days. I mentioned we're not that far away from new S&P highs or Dow highs. It makes me think of one person. And with all due respect to you, Steve, it's not you. It's Jim Lebenthal. It's Mr. All In. The guy who's been, look, Weiss's shot must be frozen. You see the look on his face? It makes me think of you, Farmer Jim. Weiss is still frozen. Because you are Mr. All In, and you've been the most bullish guy on the whole show. This week was made for you, my friend.
I'm enjoying it, Scott. I'm enjoying it. I'm also enjoying those digs at Steve. That was very well done. Look, let's keep this simple. I think there are 2 very important forces at work here. One, Delta has peaked, and I can't understate how important that is. That means children go back to school, parents go back to work. Parents go back to work in places like the ports of Los Angeles and Long Beach, helping to unclog that congestion. They go back to work in semiconductor plants in Southeast Asia that we know were hard hit by the Delta variant. These are good things. It doesn't mean the supply chain issues are solved overnight with a snap of a fingers, but it means that this starts to thaw. We're moving in the right direction. The other really important factor is the Fed. And, you and I have discussed this, Scott. We've all discussed this. Okay, the Fed's going to taper, but guess what? For the next 8 months, the Fed is going to be putting liquidity into the financial system, albeit at a lower rate, but they're still going to be swapping cash for bonds, and that is supportive for the market. That's why any correction that we've had has been really no more than 5% overall.
5%
Scott,
is the number, right?
I want to make one more point.
5%, Jim, you mentioned it. That's the number.
Yeah, that's it. We're done. We're done with the correction. But I want to make one more point, because to me this is very important. And you and I were speaking with Mike Santoli, I forget if it was Tuesday or Monday this week, and I pointed out how unloved this rally is right now, how people are doubting on the reopening trade. Now, I see that in a very specific sense, that the reopening trades, the value, the cyclical names, they usually, this week, they have all surged higher in the open and then they faded into the close. In fact, we discussed that at one day when the market started to fade midday. That's telling me something. That's telling me that a lot of people who got stuck in the first leg of the reopening trade from November of last year to May of this year, they got stuck in it, okay? And they've spent the summer saying, oh my God, what did I do? Now that trade is rallying again. Those weak hands are getting shook out, but they're selling those shares to people who are going to hold it for a rally that I think will pick up steam into the end of the year. I really like that this rally is unloved right now. I like that a lot.
Yeah, well, it might get more loved soon. Jenny, do you think it will? Is this the week that we're going to look back and we're going to say that's the week that did it? That's the week that did it.
No, I don't think so. And this is fun because Jim and I agree on so much, and his points, I know, but listen to me. So Jim's points are all totally solid, but then I see another side of it. And I see not necessarily headwinds, but I see hurdles. And these are hurdles not just for the next quarter, but for the next 18 months or longer, maybe next couple of years, which is $30 trillion of government debt. yeah, Jim, you're totally right. A lot of money is still coming in between now and next summer when tapering's done, but tapering's going to be over soon enough, which means there will not be $120 billion a month being pumped in. Inflation is looking like it might be stickier than we expect. Taxes and government regulation are not getting easier. They're probably getting a little tougher. Geopolitical issues are tough. And I already said inflation, so I've got my things covered. Sorry about that. So I look at these, and I think that there's just hurdles in the way. I look at the bank stock earnings, and this is John's point earlier. Those are great, but they're not necessarily indicative of what's to come because they're not facing supply chain issues, they're not facing labor cost issues, and they're not facing issues from energy prices going higher. I don't see a super rosy next quarter. Now, I'm also fully invested, right? But I think this is where it comes down to what's the magnitude of your bullishness. And this is really the question. Does this mean that we're going to be up 10%? If Jim's happy to, Jim, does that mean you think we're going to be up 10%? Or does it mean you think we're going to be up 2 or 3? And I think what we're going to need to do as a society, as investors, over the next several months is start to temper our expectations.
Okay.
We need to understand that the last 10 years has delivered us a 16.5% annualized return. That is unlikely to be delivered in the coming 10 years. And we just need to get more realistic.
Okay.
So when we talk about being bullish, that's fine, but let's define it.